Welcome back to your Wednesday market deep dive. We're going to get into the weeds a bit today.
Absolutely.
It is October 9th,
Yeah.
and the markets seem to be taking a little bit of a breather after those record highs.
Yeah, they are.
Taking a buzz.
Yeah. But trust me, things are about to get a little bit interesting. We've got two major events that could really shake things up tomorrow, October 10th.
That's right. And you're tuned into this because you like to stay ahead of those trends.
Yeah.
Especially with your investments.
Absolutely. So let's unpack the first potential market mover, and that would be the September CPI data.
Yes.
That's dropping tomorrow morning. Expectations are for a cool down to about 2.3% overall inflation, which, on the surface, sounds like kind of good news, right, eh?
Yeah, potentially. But, the market often reacts more to surprises than actual numbers.
Right.
So the real wild card here, I think, is the core CPI.
Okay.
Which strips out that volatile food and energy prices. Will it hold steady around 3.2%, or are we going to be surprised? Okay, so if core CPI comes in hotter than expected, could that spook the market even if the overall CPI is cooling down?
Yeah, it's definitely a possibility. A higher than expected core CPI could signal that inflation is well stickier than anticipated.
Right.
And potentially impact, the Fed's future interest rate decisions.
And speaking of the Fed, that leads us perfectly into our second potential market shaker tomorrow, and that is Tesla's big robo-taxi reveal. I mean, everyone's waiting to see if Elon Musk can pull another rabbit out of his hat.
It's true.
What's the market buzz from your perspective?
Well, it's interesting because the anticipation is already baked into Tesla's stock price. Analysts are predicting a potential swing of 6.5%.
Wow.
Yeah, landing somewhere between $225 or $255 a share after the announcement. So, it's a real nail-biter even for seasoned investors.
So it's almost like flipping a coin, huh, with Tesla. But let's say you own some Tesla stock. What factors should you be paying attention to around this reveal? How do you make sense of it all?
Oh, that's a great question. I think instead of focusing solely on the theatrics of the reveal itself, right?
Right.
Pay close attention to the details. What's the actual timeline for a full robotaxi rollout?
Mm-hmm.
What are the safety and regulatory hurdles that they're going to have to overcome?
Right.
And how does this new venture fit into Tesla's overall business strategy?
Okay.
And importantly, its profitability. These are the questions that are going to drive long-term value.
Excellent points. Excellent points. It's easy to get swept up in the excitement, but those details are key. Now, before we get too caught up in the Tesla roller coaster, we should probably touch on something a little less flashy, but arguably more impactful in the long run, and that's the Fed's recent interest rate cut.
Yes.
They slashed rates by 50 basis points.
Yeah.
What does that actually mean for the average person listening to this?
Yeah, the Fed's decision has definitely sparked a lot of conversation. And to be honest, some head scratching too. You're right, 50 basis points.
Right.
It sounds very textbooky. But in simple terms, this rate cut is meant to encourage borrowing and spending. So the hope is that cheaper loans will motivate businesses to invest more, consumers to spend more, and ultimately boost economic growth.
Okay, so that's the Fed's game plan, but will it actually work? Everyone seems to be trying to decipher if this rate cut will be enough to kind of move the needle on consumer spending. After all, lower interest rates don't mean much if people aren't confident enough to open their wallets.
Exactly, and that's where things get really interesting. A rate cut alone isn't a magic bullet.
Right.
Consumer confidence plays a huge role.
Hmm.
And right now, there are a lot of mixed signals about the economy's direction. Are we headed towards a recession? Will inflation continue to cool? These uncertainties can make people hesitant to spend even with lower borrowing costs.
So it's a bit of a waiting game.
It is.
We need to see how these different factors play out, and that's why this CPI data released tomorrow is so crucial.
Absolutely. If inflation cools down as expected, it could be a sign that the Fed's strategy is working, potentially boosting consumer confidence. But if inflation stays high, it could mean that the Fed needs to take more aggressive action, which could create more uncertainty in the market.
Speaking of waiting games, let's shift gears over to the tech sector. Things are rarely calm over there.
Never a dull moment.
It feels like there's always some drama unfolding. Especially with Google, back in the antitrust hot seat.
Yeah, they're back in the spotlight again. Why? Well, regulators are considering a breakup.
Again.
Which, yeah, this has the potential to be a really huge deal. The last time that the U.S. government broke up a company this big was AT&T back in 1984.
1984. That's like ancient history.
Yeah.
especially in the tech world. But why is everyone so concerned about Google? What would a breakup even look like?
Well, the heart of the issue is that Google has become so incredibly dominant in so many areas. I mean, you think about search, online advertising, you've got mobile operating systems with Android,
Right.
you name it.
Yeah.
And so this dominance has led to concerns about stifled competition and, potential harm to consumers.
Okay, I get it. No one likes a monopoly. But how would breaking up Google even work? Would they like spin off YouTube, or what about their cloud business?
Yeah, you're on the right track. Regulators are considering dividing Google into these separate entities, likely focusing on search, YouTube, and their cloud platform. Now, here's where it gets interesting for investors.
Okay.
While this might seem like a negative thing at first glance, breaking them up,
Right.
it could actually unlock a lot of value.
Wait, really? A breakup could be good for investors. Explain that one.
Yeah, it seems counterintuitive,
Yeah.
but right now, all those three different divisions are kind of lumped together under this one massive corporate umbrella, but they each have their own unique growth potential
Okay.
and potential for independent valuation.
So you're saying Wall Street might value these divisions higher if they were sort of set free?
Precisely. There's a historical precedent for this. When these big conglomerates have been broken up in the past, the individual parts often end up being worth more than the sum of their parts.
Interesting. So Google's fate is still up in the air, but it's definitely a situation to watch, especially if you're invested in the tech sector.
For sure.
Now let's move on to another tech giant that's been making headlines, but for very different reasons. TSMC. They just seem to be crushing it lately.
TSMC is a great example of a company that's really firing on all cylinders.
They are.
Yeah.
What have they been doing?
Well, they just announced this September revenue beat
Okay.
that blew past analyst expectations by a significant margin.
And when you say significant, you mean?
Try a 39% year-over-year increase in sales.
Wow, that's huge.
Yeah, that kind of growth in this type of environment is remarkable, and it signals that TSMC is really in a league of its own.
No wonder their stock is responding accordingly. What's driving this performance?
A few things. First of all, they are the world's leading manufacturer of advanced semiconductor chips,
Okay.
which are essential for everything these days. Smartphones, laptops, cars, AI, you name it.
Right.
Second, they've been able to navigate the supply chain disruptions much better than many of their competitors.
Oh.
And you look at the technicals, and by that I mean the charts and indicators that help us understand those price movements. TSMC is showing a strong upward trend with the potential for even further growth.
So it sounds like they've kind of found the secret sauce in the tech world.
Yeah, they're doing something right.
Now, on a slightly different note, we have Qualcomm. Their performance has been, well, I don't know, a little more subdued.
Qualcomm is a very interesting case study right now, in contrast to what we were just talking about with TSMC. While TSMC is soaring, Qualcomm's stock has been moving sideways, really lacking any significant activity.
So is that like a red flag for investors? Should people be worried?
Not necessarily. While it's true that Qualcomm's stock has not seen the same explosive growth as TSMC, it's important to look at the bigger picture.
Okay.
Their underlying fundamentals are still very strong.
So it's not necessarily a cause for concern, just a bit of a pause.
Exactly. Their current valuation and their historical performance suggest that there is room for future gains. It's one to keep an eye on, but, no need to hit the panic button just yet.
Okay.
And, this contrast between TSMC and Qualcomm reminds me of something else that we wanted to dive into a little bit today, and that's this upcoming S&P 500 earnings season.
Yes, earnings season. It's like the Super Bowl for investors, where companies report their quarterly results, and we all get a glimpse into the health of the overall market.
Yeah, that's a great analogy. And just like the Super Bowl, there's a lot of anticipation, speculation, and of course the potential for some surprises.
And this earnings season just feels, particularly significant. We've got so many market-moving events. I mean, the Fed's moves, inflation worries, tech trauma. It'll be fascinating to see how companies are navigating it all.
Yeah, I think there's a sense of cautious optimism, I'd say.
Okay.
Analysts are predicting kind of a slowdown in overall earnings growth for the S&P 500 this quarter.
Yeah, I saw projections of only around 3.1% EPS growth.
Yeah.
Now, I have to admit, that doesn't sound terrible to me.
Right.
What's the big deal about that number?
Well, you're right. It's not catastrophic.
Right.
But it is a notable drop from earlier projections.
Okay.
And it continues this downward trend that we've seen since July. So what this tells us is that, companies are facing some real challenges.
Okay.
Input costs are still high for many, and there's uncertainty about, consumer spending going forward.
So should we be hitting the panic button? If I'm like listening to this and I'm invested in the S&P 500, what should I be doing with this information?
You know, honestly, I think the most important thing for long-term investors is to stay calm and focused on the bigger picture.
Hmm.
Remember, these short-term fluctuations are normal, and they don't always reflect a company's long-term health or potential.
Okay. That makes me feel a little bit better.
Hmm.
But it would be helpful to know which way the wind is blowing, at least sector by sector.
Right.
Where are we seeing relative strength? Where are the areas of concern as we head into earnings season?
That's a smart question. From what we're seeing, tech remains a potential bright spot,
Okay.
fueled by, you guessed it, continued investment in AI.
AI.
It seems like every company is trying to figure out how to capitalize on AI,
Right.
and those investments are driving growth,
Yep.
even amidst, the broader economic uncertainty.
It's like AI is the one shining star in an otherwise cloudy tech sky right now.
Yeah.
But what about the darker clouds? You mentioned downward revisions in earnings expectations. Are there any particular sectors feeling the most pain?
Energy is definitely one to watch closely. They've experienced some of the most significant downward revisions, largely due to the volatility we've seen in oil prices.
Right.
Energy is inherently cyclical, and these price swings can have a big impact on earnings.
Oil prices, always a roller coaster. But, you know, uh, amidst all this talk of slowdowns and downward revisions, part of me wonders if maybe, just maybe, we're setting ourselves up for a surprise.
Now, there's a thought.
Yeah.
Could it be that after all these downward revisions, a positive surprise is in store? Perhaps even in the tech sector, which has already priced in a lot of negativity.
I love that you're thinking along the same lines as me. It wouldn't be earnings season without a few surprises.
Exactly.
Well, as we kind of wrap up this market deep dive,
Yeah,
I'm feeling a mix of cautious optimism and anticipation for what's to come.
for sure.
It seems like anything could happen.
Yeah,
And that's part of what makes the market so fascinating.
it is. It's part of the fun.
Well, that just about does it for this market deep dive into the markets and tech. We covered CPI data, Tesla's robo-taxis, the Fed's rate moves, the Google antitrust saga, TSMC's incredible run, Qualcomm's steady performance, and of course the always eventful earnings season. Remember, staying informed is key to navigating these turbulent times. Until next time, happy investing, everybody, or at least happy navigating.